Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from ChartsandMarkets.com runs down the major markets after skyrocketing right after the Trump election victory. The stock markets have cooled a bit and gold is down 8%. Ross looks at currencies and crude. Author of the second edition of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, joins us to chat about Toronto's major real estate downturn. From the perspective of being a longtime Tesla owner, he also looks at the electric vehicle market. Publisher of the TrendsLetter.com, Martin Straith, looks at the economic impact the Trump administration could have on Canada, gold, the bond market, Bitcoin, and copper. He believes some proposed policies could have a major impact on the revenues of network television. We'll talk to Ross Clark right after this.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from ChartsandMarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on X at Charts by Ross. Welcome back to This Week in Money.
Pleasure to be with you, Jim.
Well, the stock markets exploded right after Donald Trump was reelected as president, but we've had a bit of a correction. What's going on?
All that money that was pent up and sitting on the sidelines went and just exhibited immediate buying pressure for the first, 3 or 4 days. And all that money that was spent appears to have just dried up a little bit. But, you got Powell saying, that maybe a rate cut isn't as imminent or as quickly around the corner here. So without a rate cut, people are questioning just how much buying pressure there can be in the marketplace. It's interesting. We've got very few sectors now continuing to hold strength. A week ago, it was virtually everything up. And then this week, most of them gave back. The ones that are still holding up the best would be the financials, the XLF, the regional banks, consumer discretionary, and if you look at the small cap, the quality area, not the Russell, but the small cap quality of the SHQ, the pullbacks there are pretty minor, so maybe those are going to hold in reasonably well. From a technical perspective, November is generally the best month of the year. December is the second best. You have to watch pretty carefully, though, because for all that we've had some excellent Novembers, the poor ones, 2018, 2015, 1994, the ones that don't have the strength, you have to be wary of. So I always, as a technician, have to look out and say, what's on the horizon. So at this point, strong years would, if this was to have been one, should have held around the 10-day moving average on the S&P. That was violated on Thursday, follow through on the downside on Friday, and we're down to the 20-day moving average, which really becomes a make or break spot as far as November is concerned. You want to see it bounce in here, have strength into Thanksgiving, and then, we would normally have looked for some kind of a correction after Thanksgiving. Let's just hope that the market's got the ability to hold where it is right now, which really is a test of the highs that we saw in the early part of October. Let's look at it from a perspective of recognizing what the market's telling us rather than what we want it to do. So the lows that we saw, as I say, on Friday, are probably pretty important ones to be watching.
What's going on with gold?
Gold market down now. What are we down? 8% off the highs, 25.60, and it's starting to show some mild oversold levels. This correction in gold and silver really is all part of what's going on with the U.S. dollar. U.S. dollar index has gone from 104 up to the 107 level right now. So it's up, testing the highest levels we've seen in the last couple of years. And say it's got an 8% move in the dollar index off the lows of 2 months ago, and about 4% off the levels that we saw just 2 weeks ago, whereas gold's down about 8%. So gold's getting hit pretty hard, and I don't say probably good for a bounce, but it's going to take a while for it to put in any kind of a sustainable low right now. And that would be also commensurate with the dollar index, which is a little overbought, but from a short-term cyclic point of view, the dollar is probably got upward pressure into the middle of December. That should put a little bit of a lid as far as the action is concerned on the precious metals. In other currencies, the euro and the Swiss getting down into levels that could produce a bounce as well there. And we are seeing some commitment of traders numbers getting down to low levels that would also assist with the bounce there. Canadian dollar, one of the worst weeks that we've had in ages. We're back down to 71 cents U.S. That now puts it down to the lowest levels that we've seen as far as the commitment of traders is concerned, going back once again to March of 2020 in the price, but a 2024 year low as far as the speculative positions are concerned. We're seeing a lot more of the negative bias from the traders as far as the dollar is concerned. So, as to say, everything, bit of extremes on the currencies towards the middle of this week, and it wouldn't be at all surprised to see some minor corrective pullbacks.
What's happening on the crude oil front?
Crude oil, we're looking at $67. So this is it's trying to put in a triple bottom, but the seasonals here are not positive at all. We've been talking about how you'd be down into December, January before you look for a low, and as I say, with a test of 67, a triple bottom I don't think is that likely. I think you have to go into the mid-60s before you see a reversal, and what you'd really want to be looking for is a new low for the move and then a reversal to the upside so that you get a nice, what I would call an isolated low, where it's just springing off a support, sort of a new support level, and then takes out the old support, which had become resistant. So don't be looking to pick bottoms as far as the oil market is concerned as of yet.
Ross, thank you so much for the update.
Good to be with you, Jim.
We've been speaking with Ross Clark from ChartsandMarkets.com. Find him on X at Charts by Ross. Coming up, Hilliard MacBeth next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Hilliard MacBeth, author of the second edition of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. His website, MacBeth.McLeodPartners.com. Welcome back to This Week in Money.
Yeah, it's nice to be on your show again.
Hilliard, the second edition of your book is now on sale. Is this a good time to read it?
Excellent time. Obviously I was early in my call for a housing bubble bursting, but now we can see in Toronto especially that prices have come down about 20% on the headline number, and but then you have to adjust for inflation, so it would be a larger number than 20% adjusted for inflation. And then the actual prices are themselves were inflated because of the failure to capture all of the renovations that have been done. So they're actually probably down more like 30% when you include all those factors. So that's not technically a crash. I think a crash starts around 40%, but we're getting close. So, and the explanation is in the book about why this happened and why it will probably carry on for quite a while longer.
The Dow and the S&P 500 hit new all-time highs again this week following President Trump's landslide win. Are there reasons to be bullish on the stock markets as we approach the new year?
Well, it's hard to find reasons. Obviously people are excited that Trump got in because he's promised to cut taxes and get rid of regulations. So in that regard, and you can tell that the financial sector, especially the big banks, are very excited because after the failure of those banks, the Silicon Valley Bank about a year and a half ago, there was some talk about re-regulation of the sector, and now with Trump in that won't happen probably. So, but the problem with the stock market is that who's in the White House isn't really that important to the stock market. It's more about what are the interest rates, what is the level of stocks versus earnings, and all that, and all of those factors, the price earnings ratio, where we are in the cycle. The interest rates rising; they've risen quite a bit since the summer. Those are going the other way, so they would cause the stock market to have a correction. Also, the first year of a new president's regime is the worst year historically for stock market performance. And one theory about why that is, nobody's quite sure, but one theory is that they do all the nasty stuff in the first year of the 4-year term, so that by the time the 4-year re-election comes around, the good stuff start to work, and people forget about the bad stuff. So, and in that case, in this situation, they certainly seem to be ready to move quickly to do some significant cost cutting in that, which will have a short-term negative impact, but maybe a long-term positive impact.
After hitting $2,800 per ounce, gold's been pulling back. Could this be due to President Trump wanting to end wars and not start new ones?
The price of gold has been quite interesting. I saw a report yesterday that it actually has outperformed the S&P 500 since 2000, which is pretty phenomenal because the S&P 500 is up a lot since that time. And the reasoning for it seems to be that people are worried that the U.S. dollar is going to no longer be a good reserve currency for the world. The problem with the gold price after Trump's election is that a lot of the stuff he's talking about is inflationary. Tariffs are really inflationary. There's possibly a trade war would come into that pushes the cost of everything up. And some of the other actions that Trump's talking about are inflationary. So the interest rates have been going up in the U.S., and that's basically hard for gold to fight against because gold doesn't provide you any interest or any dividends. So, but I think the trend for gold is still very positive because of the concern about inflation. So the higher interest rates are hurting gold temporarily, but I think the gold cycle is still on the upswing.
The U.S. dollar's been moving higher since the beginning of October. Could the Trump presidency result in strength in the U.S. dollar?
So the reason for that is related to what we just talked about. So the market is assuming that there's going to be more inflation with Trump, and he doesn't care about. He wants to cut taxes. I didn't mention that yet. He's going to put on tariffs. All these things are likely to lead to higher inflation, and that means higher interest rates. And therefore, if you have your money in U.S. dollars, you're going to earn a higher rate in a treasury bill or something like that. Warren Buffett's got $200 billion in the treasury bill, some number like that. So he's been selling stocks as fast as he can and putting the money into treasury bills, and the return is pretty darn decent. Risk-free kind of thing, and the rate's going up and up and up. So that's why the U.S. dollar is very strong, and that's why the Canadian dollar is so weak, by the way. So the Canadian dollar has other problems as well, but one of the challenges is how strong the U.S. dollar is.
Yeah, is the Canuck buck likely to get crushed by a strong U.S. dollar?
Yeah, it is getting crushed, and we're down to 71.20 somethings, only less than a penny and a half away from something starting with 69. been quite a while since we saw below 70 Canadian dollar, if you look at it that way. The other way, which is the way the professionals traded, is around 140, and somewhere around 141 is where it crosses over the 70-cent threshold. So, there's a lot of negatives. The price of oil is coming down. There's a glut. The OPEC's dealing with a glut on the price on oil markets. The glut's only going to get worse if people keep buying EVs. And then there's a lot of other problems in Canada too, with things like auto exports. We don't have any of these new factories, other than a few new battery factories being built, but we haven't really landed any big Tesla factories or any of the other big manufacturers of like BYD of the new EVs. So and oil and autos and auto parts are the big exports that we deal with in Canada. Then also on the positive side, we do have lots of minerals that are going to be needed in the transition. So that's positive. But right now the negatives are really piling up. The other problem we have in Canada, but everybody everywhere else has the same problem, is the debt. The federal government debt has really piled up since COVID, and the provincial debt was a problem, especially Ontario, long before that. And of course, we've talked many times about household debt being sort of in the top 3 in the world as a percentage of GDP. So lots of problems in Canada, not a lot of visibility on what the good news will be. Someday there'll be good news, but it's hard to see what it is right now.
Yeah, for 2024, crude oil peaked in April. What are your thoughts on crude as we go into 2025?
Well, I was looking at crude oil, and it looks weak, like the way it's been acting. 2 wars, the Ukraine-Russian war and I don't know if you can call the Israeli-Gaza a war technically, but 2 conflicts, and yet the price of oil really hasn't done very well. So the problem with oil is, as I mentioned before, is in the U.S., the biggest guzzler of oil is the U.S., and also the biggest producer of oil. They're using about 19 million barrels a day in total, about 100 million. So they're using close to 20% of the world's oil production. And about half of that goes into cars and light trucks. So just cars and light trucks, not highway trucks, not planes or trains or anything like that. And there's 2 problems with oil. One is the efficiency of those new cars, even if they're gasoline cars, is much better than it used to be. And then a certain percentage of them, right now about 10% of the new cars being sold are EVs. And in other countries that's gone up to, in China it's up to 50%, but in other countries it's 20, 30%. So it's going to eat into the demand for oil. It's starting to already quickly eat into the demand for oil in countries like China.
Now, the federal government in Canada is imposing a cap on emissions from the oil and gas industry. Is that effectively a way to kill it? Well,
the oil and gas industry has been talking about, they've got something called the Pathways Alliance. They've been talking about carbon capture. So the federal government, Trudeau's government, has given them lots of leeway and offered them lots of money. But they haven't done anything yet with this money, and they haven't committed to any significant capturing of carbon. So they are allowed. They've got some room with this emissions cap if they can somehow find a way to do the carbon capture. But the problem with carbon capture is it hasn't been able to be proven on a large scale yet. And we're talking the scale. We're talking. The oil sands is up to 4 million barrels a day now. So the size of the plant, or would be multiple plants, would be just be something that Elon Musk would deal in. Nobody else would deal in that kind of numbers. So, but the industry doesn't seem to want to pay for it. So they seem to be stalling, and I'm wondering if they're just trying to make as much money as they can. I know Suncor, for instance, they just had their quarterly results, and they said the Suncor is the biggest owner of oil sands plants, I think. They got their debt down to $8 billion, and they've decided they're not going to reduce their debt anymore. They're going to start paying out bigger dividends and buying back more shares. So it's kind of like you're saying they're just going to return as much money as possible to shareholders. So they're not looking at growth. They're actually looking at the company shrinking and just try and keep it going for as many years as possible. And so that the return to shareholders will be great. But if the price of oil drops too far, then it's a highly risky project as well.
Could the end around on the 100% tariff on Chinese EVs be for China to start building factories in Canada and the U.S. and Europe that make their electric cars?
So the biggest producer of cars is BYD, a Chinese-based company, and they also make buses and other types of electric vehicles. They make a lot of hybrids as well. I just checked yesterday because I was wondering about this exact question, because they have a new truck, I think, and it looks quite interesting. It's not like a bizarre thing like the Cybertruck that Tesla has, and the specs are really good on this new truck. But of course, if you have to pay the 100% tariff, which is coming from China, it's going to be impossible to buy it. So it turns out BYD does have one factory in California. In the U.S., it's in California, but it makes buses. So I don't know if a bus manufacturing facility can make trucks or cars. I don't know. It doesn't sound like it's that close to what they need.
Well, in World War II, car factories made airplanes.
Yeah, I mean, if it's a war, if it's a war type urgency,
yeah.
And Elon Musk's new Department of Government Efficiency has in the statement that was made has mentioned the Manhattan Project. So if they're willing to do that on an urgent basis, but they aren't, they don't seem to be that keen on electric vehicles. So if they were, though, anything could be done. I mean, you could set up plants very quickly, but the manufacturing plants are not difficult. It's the battery. The battery is the soul of the electric car, and that is where the difficulty. And there are about I don't know the exact number, but there's a number of plants. I was going to try and say the number of billions of dollars, but it's in the tens of billions, if not hundreds of billions of dollars in capital expenditure to build these new battery plants. Most of them are in the south of the U.S., and different companies are doing it, I think including some Chinese companies, but I'm not sure about that. And certainly Korean companies, and they're all going to produce batteries, which is the difficult thing. And so there should be a way to work around it. If you could produce a battery in the U.S., then probably when the regulations are made, they'll say, well, if you've got a percentage of more than 60% or something of components, then you're good, and something like that. So yeah, I mean, the rest of the car is quite similar to a non-electric car, right? So you could just have maybe Magna International could make the rest of the car. It's just a question of the batteries. So the biggest battery maker in the world is CATL, which is a Chinese company, of course, and one of the other biggest ones, maybe the second biggest one, is BYD, the one we're talking about. So they'll figure that out, I think. I don't know how quickly they'll figure it out, but they'll figure it out. But it is a problem. The Chinese processing, the Chinese manufacturing, it tends to be 85-90% Chinese right now, and the Americans are way behind, and they need to catch up quickly.
You're also mentioning off air that there's been some improvements in battery technology.
Yeah, so one of the big problems with batteries is it relates to range anxiety. So people, there's two ways to go. You can make a honking big battery, which is expensive. It's the most expensive part of the car. It's also the heaviest part of the car. And then say to people, well, you've got 800, 900 kilometer range, don't worry about it, right? But that's so then you're lugging around this very expensive, huge battery for the occasional time, because most people don't need 800, 900 kilometers range on a daily or even a weekly basis. It just happens maybe once a month or whatever. So the other way to go would be to have cheaper batteries, smaller, lighter, make the whole car a lot cheaper, and just have more frequent charging. So the new things that are coming out, one of them I was just researching yesterday, is to make the anode a silicone anode instead of a graphite anode. And what happens there is it can charge up to full in as little as, I think they mentioned something like 8 minutes. And so the average stop for a gasoline car to get refueled is about 8 minutes. So if they can even get down to 10 or 12 minutes for a full charge or almost full charge for a battery, then and if the range is 400 kilometers or something like that, that'll make a huge difference, as long as the chargers are everywhere. Kind of like if they're available on a really widespread basis, which is not that hard to do. I mean, Tesla's built out a whole network all by itself. So if we do like a Manhattan Project approach, we can have chargers everywhere fairly quickly. So not complicated technology. So that would be the breakthrough in the batteries would be the big thing. And the other thing that's coming perhaps is solid state batteries. Is a little bit further, but Toyota's really gone all in on solid state batteries, and they too have a higher energy density, so they don't have to be as big, and they also charge faster. They can put more current into them. So the limiting factor is how much current can you put in the battery, and without it overheating. That's the big challenge. So, but they'll figure it out. I mean, this thing, the first mass consumption Tesla is only 12 years old. So 2012 is when it came out. So there's only been 12 years of innovation. Another 12 years from now, it'll be way ahead of where it is now. And I suspect that there's all kinds of materials that can be used in batteries that will work better than what we have now. For the high performance, like the Tesla high performance one, you still need to have those the type of battery that Tesla made for those cars that go 0 to 100 in 2 seconds. But for the average person, they don't want that. They don't even. I've got that car. You take people for a ride in it, and they get upset because it's just too much. So the people don't want that. So what they do want is either longer range or faster recharging, which is what's coming.
The Bank of Canada rate is now 3.75%. The Canada 5-year bond rate's been moving higher since mid-September. Where do you see interest rates going from here?
Well, the Bank of Canada can do whatever they want, but if rates are going higher in the U.S., and Canadian rates will probably have to go higher as well, or we watch the dollar go to 60 cents. So these are our choices. So it's not good choices. So the mortgage rates in Canada are rising, and that's the most important part of the monetary policy matrix. And so rates are rising, and it looks like they're going to rise further with the changing government in the U.S. And that's not going to be good for Canada. That's one of the reasons why the Canadian dollar is so weak right now. It's if we raise rates to keep up with what's happening, we kill a housing market that's already in big trouble in Toronto and Vancouver and probably everywhere. And if we don't, then the dollar goes down to 65 cents, and that creates another whole set of problems as well, which in the end we end up raising interest rates anyway. So we might as well raise the rates and go with it. And but the Bank of Canada got out quite far in front of the U.S. The U.S. had not cut rates, and the Bank of Canada had already cut rates by 2 or 3 times, and with a 50 basis point cut in there as well. So they were kind of sticking their necks quite far out. And if they had to reverse it and start hiking rates to the Bank of Canada, they don't like to look bad like that, but they might have to do it.
Could mortgages resetting in Canada be bearish for the real estate market?
Oh, absolutely. The big mortgage reset is underway right now, and people have got mortgages between 1% and 2%. I remember not that long ago saying, "Oh, that's great, you got that house, and you probably got a mortgage at 2%." And they said, "Oh no, I got it way better than 2%. I got down at 1.5% or something like that." I forget the numbers exactly, but it was like that. And they were so proud of what they got. And of course, it's that if it's a variable rate, it's already reset, and if it's a 5-year rate, well, it's coming up pretty soon. So something like 50% of all the mortgages that have not yet reset are going to reset in the next year and a half, and at much higher rates than we're talking 3-4% versus 1 or 2%. So, given that a lot of the people that went in there barely qualified for those mortgages when the rates were that low, there's going to be a lot of trouble, and there already is. The place it shows up first is in the credit cards. So the first thing people fail on is the credit. First, the credit card balances go up. People that used to pay off the credit card balance every month down to zero, they start letting the balances accumulate. Then they start not making the payments. So then the credit card people are fairly quick to report if they're in delinquency, and those numbers are skyrocketing. And then a year or two later, they show up at the bankruptcy and insolvency trustee office, and those people have told me that they're starting to see much increase. They said one of the things the bankruptcy people told me recently was that didn't used to see homeowners ever come in. It was always the people that are renters, and then they get in trouble on the unsecured loans and the credit cards and stuff. Now they're starting to see homeowners come in, and the reason for that is that the homeowners can't refinance or sell the house anymore to pay off their debts. They have the price declines or flat prices, and that doesn't give them any room to refinance. When the prices were rising 10% every year, they could always bail themselves out.
President Trump's talking about eliminating federal income tax and introducing tariffs. Would this likely ignite the U.S. economy, and should Canada consider doing that?
Well, I think Canada won't have any choice but to match what the U.S. does, because the U.S. Will insist under the U.S.-Mexico-Canada Free Trade. I always forget the acronym for that. U.S. CAMA or something. There's kind of free trade, supposedly free trade between the three countries. So if the U.S. does something and Canada doesn't match it, then they'll cut us off. So we can't afford to be cut off from the U.S. There's something like 70 or 80% of all our exports go to the U.S. So we have no choice but to do what the U.S. wants us to do. And when the first U.S.-Canada Free Trade Agreement was Mulroney in the 80s, I think, did it, and they got a really good deal. But ever since then, I think it was between Mulroney and Reagan, and they gave us a pretty good deal. We had a trade negotiator, and he walked out of the meetings, and he had demands, and they caved. The Americans caved, and but since then, every time it's little things have come up in that, the Americans have been much tougher with us, and Trump especially is really being tough. He's really tough on his close friends and really hard on people that you would think normally would be enemies, but that's another story. So yeah, I mean, it's this whole tariff thing is nobody has anything good to say about it. It creates all kinds of friction. People retaliate if they can. Canada isn't in a position to retaliate, but other countries are. China, for example, can retaliate if these tariffs go through at the levels that they're talking about. So it's going to be, and overall, the net impact is a reduction in the growth of the economy. So if GDP was going to be 3%, after the tariff war, it comes down to 2% or whatever. It goes down by some number like that.
President Trump announced this week that Elon Musk and Vivek Ramaswamy will lead the Department of Government Efficiency to dismantle government bureaucracy, dismantle excess regulations, cut wasteful expenditures, and restructure federal agencies. What do you think this could do for the U.S. economy, and should Canada do the same?
So this is a great topic. So first of all, it's not Elon Musk. It's the great Elon Musk, capital G, with great. So, and it's the patriotic Vivek. Thank you for saying his last name because I can't. But so the great patriot and the great Elon Musk are going to cut. But when you look at the U.S., so there's several things in there. One of them is, and Elon Musk has talked about this quite a bit over the last few months, is the deficit, which is absolutely out of control. It's $2 trillion. This is on spending of $6.75 trillion. So basically what they're doing is they're taking in about 4.5 or 4.6 trillion, and they're spending 6.6 to 6.75 trillion, which is, like a 30% deficit, which is, the European Union in their constitution, when they started in 2000 or whatever it was, they had the Maastricht Treaty. The deficit couldn't be over 3% of GDP. So this is a deficit that should be maybe 200 billion, and it's more like 2 trillion. And spending. So I checked. Spending has not gone up really any faster other than the COVID thing, which was a big spike. Everybody knows about that. But if you remove that, because it's come right back down to the trend line that was in place before. The growth in spending has not been particularly out of control. It's a little bit out of control, but not anything serious. It's the revenues have dropped way down, and that happened starting in 2000, and has continued with Trump in 2016, where he cut personal income taxes and corporate income taxes, and now he's talking about further cuts in the corporate income tax. So he started at 35% corporate tax. He dropped it to 22, and in the campaign he said he wanted to drop it to 15. So the revenue is the problem. Now, what government is going to raise taxes to get more revenue? Right? So Biden and Kamala talked about doing that, and they didn't get elected. They got defeated on all three branches. They got thrown out. So obviously no government is going to raise taxes. So that means we got to cut spending. So Elon Musk and Vivek have been tasked with cutting spending, but it isn't just that. They're going to get rid of excessive regulation, red tape, and that sort of thing, and a few other things. So the biggest items in the U.S. government spending are things like Social Security, health, and defense, and then the interest on the debt. So there isn't much they can do about the interest on the debt. It's over $1 trillion. Defense is about $1 trillion. So between defense and interest payments, that's $2 trillion. And health is the biggest one at about 1.8. That includes Medicare and Medicaid. So what are you going to cut in that? So if you wanted to cut Social Security, it's protected by legislation. If you want to cut Medicare, Medicaid, they're protected by legislation. If you want to cut defense, well, probably the voters wouldn't go along with that. And there's nothing you can do about the interest rate. So there isn't a lot of what they call discretionary spending that where they can find $2 trillion. And they could completely eliminate all the government employees in the federal government in the U.S., and it would save about $300 billion. It's a tiny, tiny fraction of what they need. It's less than 5% of the total cost of government. So it's not going to be easy. Now, Elon Musk probably knows that, so I don't know. It'll be interesting to see what he comes up with. I can't imagine he went into this without checking the numbers himself. But he may be more concerned about the regulation because he's got issues with Tesla and he's got issues with the spaceships in terms of the government regulation. So he may have agreed to do this job in order to get some relief on the regulatory side, and maybe he doesn't care as much about the spending. But I mean, the spending is a problem. It's a big problem. There's some big losses in there, and as long as they can keep printing money and paying, financing the deficit through that way, it can go on forever. But at some point, people might say, "Hey, you know what? I don't want to hold a U.S. dollar anymore. I want to hold gold instead, or some other substitute for the U.S. dollar." There isn't a currency that I can think of that's particularly good as a substitute, but there is gold, and some people like Bitcoin. I personally don't, but there's other options that people can use, put their money into.
What is the equity risk premium?
So when you calculate I'm going to simplify. It's a little bit more complicated than this, but this is the basic thing. So if you take a stock, everybody knows the price-earnings ratio. So the price-earnings ratio is, let's say, 20 times, which is about the average. It's higher than that now. We're actually at very elevated levels now, but 15 to 20 is kind of like the long-term average in a good stock market. So to make the math easy, let's say the price-earnings ratio is 20. That means a dollar of earnings gets you, the stock costs $20. So that's if you invert that, that's a 5% yield. So the earnings yield can be stated as a percentage, and in this case, a 20-to-1 ratio is 5% yield. The bond market, on the other hand, is just a payment, and if it's government bonds, it's pretty safe. It's been safe for many, many decades without much risk of loss of money. So they consider the government bond, especially the short-term government bond, as no risk, and they consider the equity market as risky. So if you're getting a 5% yield on the stock market because you're paying 20 times earnings, and the government bonds are also 5%, then you're basically taking all the extra risk of the stock market over the bond market, but there's no premium. So you're not getting rewarded for taking the extra risk. So the equity risk premium, it's an interesting question right now because it has actually gone to zero. It's normally a number like anywhere from 1 to 5, or in a really bad bear market, it can get up quite high. In other words, you're getting a big discount on stocks compared to what you'd get in the government bond market. But right now, there's very little equity risk. So you can go ahead and take all that risk in the equity market, but you're not getting rewarded with a big premium over what you would just get in a government bond.
Are you seeing signs of the housing bubble bursting in Canada?
Well, for sure. The official numbers are in Toronto. Toronto's leading the decline in house prices. The average price peaked out at $1.4 million, and it's dropped by about 253,000. I just saw this, so I just got the numbers in my head. So 20% would be 280,000. So it's just right around 20%. But of course, that average includes a lot of stuff. So there's in there is in the suburbs, the big houses that were built, like Brampton and those places, they're down way more than 20%. And in the condo market, the prices have come down a lot more than 20% as well. The single-family homes close into the center of Toronto have not dropped as much as that. But we're at that stage now where it can tip. It could either come back into a upward market at some point fairly soon if its rates came down fast enough, and if there's no recession, or it could tip into a bursting of the bubble. It's kind of right on the cusp between those two things. Anything above 30%, you'd say was a major correction, and above 40%, as I mentioned a minute ago, was considered a crash. So for the bubble to fully burst, as my book title indicates, you'd have to see at least 40% and maybe even higher than that to get back to the definition of the bursting the bubble, by the way, is prices go back to where the trend line was that was in place before the bubble formed. So this bubble started forming in 2000, 2005, somewhere in there. And you just draw a line of, normal increase in house prices at, say, the same rate as the economy, GDP, 4 or 5% kind of thing. And the rate of increase in house prices when the bubble got going was double the rate of increase in the GDP and double the rate of increase in wages and salaries. And so it would have to drop quite a bit to get back to where it would have been. In housing price terms, you could say that 1.4 million in Toronto would have to come down to about 700,000 or something for the fully deflation of the housing bubble. And I don't know if it's going to happen. I think it's going to happen. I've given up trying to say when it's going to happen, but interest rates are rising, and we're probably already in a recession, or if we're not in a recession yet, we'll be soon. So, I don't see the upward trend line resuming anytime soon. Even in Edmonton here, which is the second best housing market in Canada, Calgary being the best. This is totally anecdotal, but it is really odd. I think we live in a quiet, older neighborhood close into the center of the city. So there's the lots are expensive here. There's been 3 foreclosures in the last 2 years of these older homes. They get foreclosed on because nobody wants to buy them because they're a little bit too expensive for a teardown. And there's been 3 of them, and it's like there's 2 more right now that are under construction that are probably going to go into foreclosure as well. So that's 5 in a small area. When I walk my dog around, right? So I'm thinking this is really odd. I haven't seen that many ever. And of course, they don't put a sign out saying this house is just got a for sale sign. It doesn't say foreclosure on the sign, but we have a friendly realtor in our neighborhood, and talk to her when I see her when I'm walking the dog, and she tells me that these things. So yeah, I don't know. Something's happening. There's definitely, and it's about the debt and the interest rates, right? So that's what it's all about.
How is the Toronto home market compared to the Vancouver home market?
So the big thing in Toronto, as we talked about, is the prices have come down about 20%. But the condo market, there's a huge glut of condos because they've got something like 200 cranes still operating in Toronto. Most of those 200 cranes are producing condos or rentals. But rentals are bad for condos too because they compete with condos, and it's cheaper to sometimes rent than it is to buy a condo. So that market is well on its way to a pretty dire situation. Vancouver, on the other hand, I hear stories that, things are starting to weaken there, but I haven't seen any real hard numbers that say prices have come down anything like what's happening in Toronto. So Vancouver's holding up better. Vancouver had slightly bigger gains than Toronto up till 2022 when Toronto started to come down. But by the way, 2022 was the peak in Toronto. And we've seen a little bit of a drop in Vancouver on the official numbers, but nothing like the 20% we're seeing in Toronto.
If home prices are dropping at the same time as the Canadian dollar is dropping, is this a double whammy?
Well, yeah. I mean, if you don't have U.S. dollars, it's like you're trying to buy. I guess in one way, you're no worse off. You're getting paid in Canadian dollars and you're buying houses in Canadian dollars. But if the price doesn't drop, then But for the American buyers, if they were interested, they're getting like maybe a 20% discount in Canadian dollars and maybe a 30% discount if you take into consideration the currency exchange. So, but I don't think they're that interested yet. I mean, most of the money that was coming into Canada was not coming in from the U.S., was coming in from China and Iran and other places like that. So the Americans have lots of real estate they can buy in North America that they don't have to come to Canada for. So they do seem to come to Canada to buy, like farmland and stuff like that, or vacation properties in BC, or, some of those islands in the Gulf Coast offshore Vancouver. They're about half the places are owned by Americans, but those are more just kind of like leisure properties kind of thing. But I don't know. I don't know if we as long as it's falling, we generally don't get a lot of foreign money coming in. That the foreign money tends to be late. In other words, they don't tend to wake up to a trend until it's well established. So the market would have to bottom. We're just in the very early, if 2022 is the peak, 2024, usually these things last 6 or 7 years, so we're not even halfway through. It would have to be actually bottoming, and then it takes a while for people offshore, like in another country, to notice that things have turned positive again. So it might even be 2032 before the Americans got interested, or the other people got interested in coming back into the Canadian market. So for several years, they'll just have they'll just put a little, X over the Canadian market. Say, oh, that's so interesting. I got lots of other places I can go to. Because the thing is about foreign hot money, they call it, is it can go anywhere in the world. It doesn't need to come to Canada, right? So the Canadians, they need to buy in Canada, but if they've got a job here. But this footloose money, that's the hot money that's cascading around the globe from Russia and different places, it can go anywhere. So they're looking for an upward trend before they want to put their money in.
Do you think President Trump returning to the White House could affect the Canadian economy and home prices?
Yeah, well, it certainly could. And the big thing to watch with that is tariffs, because we've got that. We used to have this ace in the hole, because we had this oil from Alberta that we were shipping down to the U.S., and we still are at the rate of about 4 million barrels a day. But the Americans are now by far the biggest producer of oil in the world. So they are, I mentioned a minute ago, they're consuming about 18 million barrels, but they're producing about 14 million barrels, and they import from us about 4. So they don't need any imports from anybody else other than Canada, and they're exporting oil as well. So they've got excess oil production. So they import oil from us, and then they export. So if we cut off the oil supply tomorrow, that's really our only big sanction we could put on against the U.S. in some kind of a war over tariffs or trade or something. They would hardly even notice, because they could easily make up the difference by bringing in some imports from Saudi Arabia or some other country. So we don't have a lot of negotiating power with them. So if they want to play tough with us on tariffs or trade or something like that, then we're going to have a problem with dealing with them. We used to go and try and convince them to make an exception, and say 3 out of 4 times they would agree to do that. Usually after we had to give up some stuff in the negotiations to make them happy. But dealing with the Trump White House on tariffs is much more difficult, because they're sort of all or nothing kind of people. So it could hurt but the bigger thing is the higher interest rates. So if the U.S. interest rates keep going up as they are, and we have to move our interest rates higher because we have to match them, that hurts it'll hurt the economy quite a bit. It'll hurt the stock market quite a bit. It'll hurt the real estate market even more. Probably the real estate market's the most vulnerable if we have to raise our interest rates to match U.S. interest rates.
Have you heard anything about Edmonton being broken up into 15-minute cities?
Well, it's a policy of the city council, but you walk around, you don't see any lines drawn on the streets. The idea is that you should be able to get everything you need within a 15-minute walk of your home. So they want to kind of recreate that European situation where you could, maybe take public transit home from work and get off and collect your milk and your bread or whatever else you need from a shop that's just within walking distance and like that. But the problem is Edmonton is built on the automobile, and people don't want to give up their automobiles. I don't see them giving up their automobiles. I think the best we can hope for is they agree to go electric. And then, of course, this driverless shuttle thing is interesting, because if you got cars without a driver, and you can call them on your app on your phone and take a quick trip to the grocery store or something like that, or have it delivered to your home. That makes more sense than having all the duplicate. I mean, it's really hard to convince a small business person to put a whole bunch of little shops in the neighborhood where maybe they're only going to get 1 or 2 customers per day, kind of thing. It's just the world. It's a nice idea, but the world trend is going completely the opposite direction.
What are condo investors likely to do as prices turn down?
Well, condo investors are a very hardy breed. They can handle a lot of pain. So when I started this whole thing, it was 10 years ago almost now, and I talked to some of them in Toronto at that time, and I did some back of the envelopes calculations, and I asked them, say, well, from what I can figure out, you're renting it, in those days it was like $1,500 a month, but you've got this condo, it costs you $500,000 and blah, blah, blah. It looks to me like you're losing it, or maybe at the best break even. Is that? And they said, yeah, well, actually it's costing me $100 or $200 a month. I said, well, why do you keep the place? And they said, well, because the price is going to go up, and when I sell it, I'll recoup all these monthly losses into a big gain on a windfall gain when I sell it. So I thought, oh, okay. And I didn't say, but then I look around. There's 200 cranes. There's been 200 cranes active in Toronto for probably 10 years now. You say, well, gee, all these new condos are going to look a lot better than your old 10-year-old condos. So it just doesn't add up. But anyway, they've held in there, and they've gone through a lot of them have gone through the turmoil of renters moving out and having to get new renters in, and all that headache and stress and cash calls, from the condo board, because they got to fix some mistake the builder made and stuff, and it's just a nightmare. And the problem with condos is, of course, you don't have any land, or you have a very little land. Your portion of the land on which a high-rise condo is sitting is very tiny. So almost all of your so-called investments, not really an investment at all, is in the building, and the building is depreciating, is deteriorating every minute of every day. And money has to be spent on it. So it's the condo, especially in Toronto, there's such an overbuilt glut of condos. It's a disaster it's here now. I don't think it's in the future anymore. I think it's arrived now.
What is super hot rock energy, and where can we get some? Well,
so it's difficult to get it. So to give you an idea, if you go down 5 or 10 meters below the ground, this is true everywhere in the world, apparently. The average temperature there is the same as the year-round average of temperature. So I happen to know Edmonton is 5 degrees Celsius. So because it's relatively cold in Edmonton, you go down underground, it's 5 degrees Celsius. That's great, because in the winter it's minus 30. So if you could tap into that 5, you could have something. You could just use a little electricity, boost it up with a heat pump, and you've got toasty warm. And in the summer, you could use that 5 degrees to cool off from 30 down to 20. So that's 5 or 10 meters. If you go 2 or 3 kilometers down, you get, in some areas like Iceland and some parts of the U.S. in Colorado and that, you can tap into some hot reservoirs of heat. Those are, the problem with those ones, they've been around for a long time. It's called geothermal and great, but the problem is people build plants to get this heat, and it's maybe 100, 200 degrees, 300 degrees, I don't know. But the fact of you tapping into that heat, what you do is you circulate some kind of a liquid through the formation and bring it up to the surface. So if you go down to 10 to 15 kilometers, it's 400 degrees, and it doesn't matter. It stays 400, and that is very, very valuable heat. Now, that can be used for any kind of industrial. It can be used for making steam to make electricity. It can be used for any number of things. So that's what it is, and there's several companies in the world now that are working on, they're all private companies. You can't buy them on the stock market, but they're working on tapping into that. The big problem is drilling down to 12 or 15 kilometers is a challenge. You got the oil and gas experts working on it, but they're used to only going down about maximum about 5 kilometers. So that extra 10 kilometers is the challenge. But I suspect they will solve it, and that'll give us a whole new source of energy. Beyond the sun and the wind, we'll have the deep rock as well.
Well, here in British Columbia, we have the coastal mountains and the Cascades, and it's loaded with volcanoes, which means those hot rocks are a lot closer to the surface. We have hot springs here.
Yeah, that's the thing. I mean, that's the geothermal that I was talking about. That is really big in Iceland. I mean, Iceland, they run the whole thing on that,
whole country.
But that's only in certain areas, right? Yeah. You can't get that everywhere. Whereas the deep rock, the really deep stuff, it's everywhere, because you're getting close to the center of the Earth is really hot. We're talking thousands of degrees. So. That's the challenge, but the drilling challenge is still probably 10 years away before they can solve it.
Do you think stronger economies in Canada and the U.S. would lead to more and more electric vehicle sales?
Well, I think if they let the Chinese electric vehicles that are already being manufactured now in, they don't need a strong economy. People would switch to those things because they're cheaper and they're better. So it's like, if somebody is unemployed and they can still afford to buy a new car because it's only $15,000 rather than $40,000, I think is the average price for a traditional car. So I don't think we're past, like in the early days of EV, it was just basically the pioneers like myself who would spend way too much money to be an early adopter. But now we're at the stage now where people are opting for it because they save money, and then they find out it's so much better for other reasons too. But so, I don't think the economy is going to affect it. I think it's other than the fact that people delay buying a new car when they're worried about the economy, right? But setting that aside, almost everybody I talk to is considering an EV as their next possible car. And remember, the fleet in North America is the oldest it's ever been. It's up to something like 11 or 12 years. The average is 9 or 10 years, so it's 10, 20% older fleet than normal. And part of it is because people are delaying their purchase.
You're fading out again. You're fading out.
Sorry. Anyway, I think it's coming whether we have a recession or not. The conversion to EV is very, very much with us.
Elon Musk is talking about a 2,000-mile battery. Could this be a game changer for electric vehicles?
2,000-mile range, I think that's just a marketing ploy. Most people don't even need 500 miles, right? So the average ICE car is about 500-mile range or 800 kilometers. People can get by with less than that without any problem, unless they're like driving regularly long distances for their work. And so why lug around a huge battery that you don't need? But I think it's just this kind of a marketing ploy that they're talking about. But most cars won't need anything like that. That highway trucks might like to have and they've got a lot more room and they can carry a lot more weight for a big battery as well.
Where's the best place for people to follow you?
Well, I'm still quite active on Twitter. I kind of like a lot of people are getting kind of annoyed about all this political stuff that's on there, but hopefully that'll die down now. And that's probably the best place. And then I do a weekend note, which people can subscribe for free to. And the best way is to go to MacBeth McLeod Partners and sign up, or it comes out on Fridays. So you can find a tweet, a posting, and it'll have a link to the weekend note. And then there's easy sign up facilities there. So that's the best way to keep in touch and track it. It isn't always about. I'd like to write on the stock market, the economy, the interest rates, and the general trends in society, China, and that sort of thing. So lots of different things. Whatever is the most interesting thing at the moment.
Hilliard, thank you so much for being on This Week in Money.
Thanks very much, Jim.
My guest has been Hilliard MacBeth. His website, MacBeth.McLeodPartners.com. He was speaking to us from Edmonton. Coming up, Martin Straith, next on This Week in Money.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News, online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
My pleasure, Jim. Thanks for having me.
The stock market surged after the Trump victory in the election. What sectors will be the winners and losers in a Trump administration?
Well, as we've seen, the markets seem to love the pro-business platform of Trump. Expectations of, tax cuts, deregulation, protectionist policies, and of course the big claim of being able to cut government fat. That's boosted a lot of sectors. So there's been a lot of winning sectors. Obviously you got financials, impact reduce financial regulations. So that's reducing compliance costs, and that'll help their bottom line. And that should potentially increase lending activity, which should boost the economy. I mean, broker dealers, that's another piece of the financial sector that should benefit massively from reduced regulations. And if you look at industrials, I mean, think about energy, drill, baby, drill, impact from deregulation, pro oil and gas policies, especially for, the service sector, such as drillers. We may talk a little bit later, but I think that, the price of oil is probably going to suffer a bit because of, increased supply, but the actual service sector should do well. Benefit there, of course, reduce regulations, loosening environmental restrictions, and then supporting growth of the domestic production. And then if you think of, how about infrastructure and construction, spending on highways, bridges, airports, the companies that are in the construction, engineering, materials, they should do well. Manufacturing, tariffs on imports, well, that should boost domestic steel, heavy machinery. So those companies should do okay. And of course, defense and aerospace. Trump is anti-war, but he's big on strong military deterrent. His mantra was peace through strength. So you need to expect more spending on defense. And then of course, in general, small caps love deregulation. Now the losers, I mean, the obvious big loser here is going to be renewable energy. I was just looking at the FAN, so that's the wind ETF. So that's down 14% since October. The solar ETF, TAN, that's down 16% since the election. Technology stocks, the ones that rely on global supply chain, well, if you get tariffs, that's going to hit companies that need to import parts and materials, like, especially from China and sources like that. And then think about the agriculture sector. Look at like soybean, corn, dairy. They could really struggle if trade tensions lead to loss of foreign markets. Again, I'm thinking a lot about China, and then the auto industry. Protectionist policies. That leads to tariffs on imported parts, so that could hurt the automakers. Again, if they rely on global supply chains. Well, what's really going to be interesting to me is what's going to happen with Canada. Canada and the U.S. auto industries, they're so deeply integrated. We've got supply chains crossing border back and forth. So tariffs there could really disrupt the supply chain, impacting American companies relying on Canadian-made parts. It'll be really interesting to see, and I'm pretty sure that we would see, Trump probably give a pass to that sector because it's so integrated between the two companies. And then another one is the pharmaceuticals. They've already pulled back, and I think we're going to be talking about that a little bit later because there's a big issue coming up in that sector too.
Why would small cap stocks benefit so much from a Trump administration?
Well, small caps, they're very sensitive to regulatory costs, much more than the multinationals. Small companies, they don't have rooms full of lawyers like large corporations do to navigate all the regulatory obstacles. So if they get a decrease in regulation, that certainly should enhance profitability and growth opportunities for smaller firms. So, you think about infrastructure spending. Well, small caps, include many companies in industries like construction, manufacturing, and materials. So they would benefit directly from increased government spending on infrastructure. And then if you look at the related trade-related risks, well, small companies, they derive most of their revenue from domestic sales, not exports. So they have less exposure to international trade issues compared to large cap companies. And then with Trump's protectionist rhetoric and focus on, wanting to renegotiate trade deals, well, small caps will be way less vulnerable to any potential fallout from a trade war. So yeah, they should do quite well given all, if Trump implements all of these things he's talking about, the small caps should do fairly well.
With the U.S. potentially moving forward under Trump's pro-business policies, what does that mean for Canada?
Well, this is going to be very interesting. Now we're Canadians, so it's not a good sign. I mean, the Canadian economy is already fallen way behind the U.S., and that's under the Biden administration. So, if Trump's policies, they're about to kick in, well, that gap is going to widen dramatically, especially if Trudeau, sticks to his heavy corporate tax policies. If the Trudeau government doesn't level the corporate tax playing field for Canadian companies, man, they're going to get hit, and that's going to really hit the Canadian economy. And if Trump slaps tariffs on Canadian products, that's going to hurt the Canadian exporters. If Canada retaliates, and then that's going to hurt Canadian consumers, as the prices of U.S. imports would rise. And then if you look at the currency, I mean, the Canadian dollar's already dropped, today, what is it out here, 71.3 cents. So if you're an investor and you see these U.S. policies being much more pro-business than Canada's, well, they're going to invest in U.S., not into Canada. And that's going to knock the loonie down. And I'm expecting the loonie to go below 70 cents. And then you look at foreign investment. Trump's policies include corporate tax cuts, incentives for business to stay in the U.S. or to return to the U.S. And that will mean Canada is going to struggle to attract foreign direct investment. So, and then you can look at it like, what about a brain drain? You got pro-business policies and tax incentives in the U.S. Well, that's going to attract skilled Canadian workers to migrate south for better opportunities. I mean, they get paid in the U.S. dollar. The companies are probably going to, grow much faster, and that's going to result in a potential brain drain. Now, the one other side of that is the pipelines. So, if Trump supports pipeline projects like the Keystone XL, which he did when he was last in power, that should at least benefit the Canadian oil and gas producers.
You tweeted or X'd that a Trump administration could ban Big Pharma from advertising on national TV. What would that mean for network revenue? Well,
this is a really interesting development that, you're not seeing a lot of media play on it. But if it were to be implemented, this would be huge. Pharmaceutical companies, they allocate, substantial budgets to advertising, significantly impacting, media company revenues. The latest stats I could find were 2021, but back in 2021, U.S. pharmaceutical industry spent almost $7 billion on national TV advertising, and that was about 75% of their total expenditures. So the industry's commitment has ensured that media outlets continue to receive significant revenue from pharmaceutical advertising. So we're talking especially television networks. So you're looking at, BN or CNN, Fox, CNBC, etc. So if the Trump administration, now he's got, Robert F. Kennedy Jr., sounds like he's going to be part of this health program. Well, RFK Jr., he's pushing for a ban on big pharma advertising. And so not only would it hit big pharmaceutical companies, but the TV industry as well. For TV networks, I think this could be a real crippling shock to them. That industry's already been really struggling. This is something I'm really keeping an eye on.
Trump just appointed Elon Musk to head the Department of Government Efficiency. What do you make of that?
Yeah, the dodgy department. Of course, being Trump, the Doge crypto coin shot higher with that. This is going to be another really interesting thing to watch. Clearly there's no question that government waste and inefficiencies are everywhere. You got the U.S. debt, 36 trillion. That works out to about 106,000 per person. Their deficits, they're adding 2 to 3 trillion every year. So there are countless examples of massive government waste. And it's not just the U.S. I mean, we're in Canada. I see the Auditor General reports every year highlighting, what she calls gross mismanagement of public funds. And that's pretty standard across the board. I just saw an article the other day. It said after 2 years after the Trudeau government put up nearly $9 million to help build, now get this, Jim, the world's largest edible cricket factory. You got that? The largest edible cricket factory. So Canada put in $9 million. Well, that facility is now dramatically cutting production, and it's laid off 100 of its 150 staff. I mean, you can't make this stuff up. Since Trudeau took office 2015, he's grown the size of the public service by 45%. And I don't know about you, but I haven't really noticed any real improvement in government services. So the need to cut government waste is very real. But, I mean, the real question is, can they actually do it? Can they cut spending and lay off government employees? Now, one agency in the U.S. government that I'm sure they will probably be the first take the first shot at will be the Environment Protection Agency. That's the center of what Trump wants to change. He doesn't believe in renewable intermittent power, so we're talking about solar and wind. He does love nuclear, so, uranium will do well, so take note there. But this is going to be a really big challenge to do any serious cut in the size of government. I think it's going to be interesting to see how much energy a guy like Musk has to deal with all the roadblocks he's going to run into. This isn't the same thing as owning Twitter, and cutting 80% of the staff. Government agencies are large, they're complex, they're very resistant to change. Public sector unions are big, powerful, making, any downsizing contentious and legally challenging. Established procedures in government. I mean, they will make every effort to slow down or block any attempt at aggressive restructuring. So it's going to be a huge resistance also from, you think about the special interest groups and lobbyists. I mean, a lot of these politicians get their pockets stuffed from these groups. So it's going to be really interesting to see how many Republican representatives actually fall in line with slashing government spending. Like I say, these guys, they do pretty well when these lobby groups start coming by and, handing out some freebies and stuff. So 73% of government spending in the U.S. is considered mandatory, but that means that 27% of government spending is not mandatory. So if there really is a will, there is money to be cut. So I think this will be fascinating to watch, but I suspect that after a few attempts at cutting and then all the media uproar and all of the pushback, that Musk is just going to go back to building rocket ships or whatever other endeavor he finds a little bit more appealing.
Well, yeah, one of my greatest examples of U.S. government waste is the Army paying $1,250 for an optically guided kinetic connecting device. You can buy one for $12.95 at Canadian Tire. It's called a hammer.
Yeah, exactly. But it doesn't have the U.S. Army stamp on it.
Of course, it's combat approved. It's Army grade, military grade hammer. So what's happening with the U.S. and Canadian dollars?
Well, I just talked about, rocket ships. So the U.S. dollar, I mean, it's blasted higher since the start of October. It's up almost 7% in 6 weeks, I think. I mean, that's crazy for a currency. And especially we're talking, this is the world reserve currency. So, and it's really interesting to me, given that Trump has made it really clear that he wants the U.S. dollar much lower. I mean, I don't know if you remember back in 2016, he crapped all over the U.S. dollar. He hates the strong dollar. He wants the U.S. dollar lower. He's claimed that Asia and Europe have been artificially keeping their currencies lower. The U.S. dollar is overbought here. But as we discussed before, currencies tend to overshoot up or down. And, but when they do turn, it can tend to be pretty dramatic. So I'm watching for a potential turn in the U.S. dollar as we get closer to Trump taking over. But if you look at what's happening in the bond market, especially the long bond yields, the strong U.S. dollar kind of makes sense because long yields are rising, and that suggests that we've got inflation, at least on the minds of the bond traders. And that suggests that even though the Fed will likely cut rates in the near term, longer-term rates are likely to keep rising. So that gives bid to the U.S. dollar. It was even interesting this week. We just saw Fed Chair Powell. He just cooled down expectations of a cut in December. So it seems like the Fed is actually starting to get a little bit concerned again about inflation. So we're watching for a turn in the U.S. dollar. It's not happening yet, but I think we're getting pretty close. Now, if you look at the Canadian dollar, you get the opposite reaction. Since late September, the Canadian is down, 2.5 cents, I think it is, about 4.5%, sitting today at 71.3. So any strength in the U.S. dollar, that means most other currencies are going to have an inverse reaction. So near term, we should see the U.S. dollar pull back soon, especially if we see Trump starting to aggressively talking it down. And if that happens, the Canadian should at least get a bit of a reprieve. But longer term, I am not optimistic on the Canadian economy, certainly especially if Trump implements those policies, which we talked about earlier. And that means the Canadian dollar is going to struggle. I'm looking for the Canadian dollar to be below 70 cents in 2025.
Gold has struggled since Trump was elected. What's the story there?
Yeah, gold's down, what are we looking at here? It's about 8% from its high last couple of weeks ago of 2,800. Currently, it's about 2,567. Remember, though, that gold's up over 50% since October 2023. So, pullback here is not only natural, but it's healthy. It was overbought. It needs to kind of cool off, and it gives opportunity for investors to kind of get back in. We're testing the 100-day moving average, which is at 2560, so we're only about 6-7 points above that right now. The 200-day is at 2410, so that'd be like another 150 points down from that. So, prior to the election, we saw both the U.S. dollar and gold move higher in tandem. But as soon as Trump declared the victor, the U.S. dollar kept rising, but gold dropped. And so why is that? Well, you think about it. So investors, gold's been overbought for quite a while. So investors take profits. They see the stock market's been rising, so they've been buying stocks. Certainly crypto has been gaining, and some of the other assets. Now, gold often acts as a safe haven, especially with geopolitical tensions. But, Trump, one thing, you can hate him or love him, whatever, but Trump is anti-war. And he's promising to, get peace in the Middle East and to help negotiate, Ukraine-Russia peace settlement. And so there's this perceived calm that he could actually, do something in these conflicts and get a peaceful resolution. We'll see about that, but certainly that part of that, taking some of those, geopolitical tensions down, and that's kind of knocked gold down for that. And then, of course, another factor in gold's decline has been the incredible strength of the U.S. dollar. So our take is this is a healthy pullback, and we're watching key support levels. I think you want to be buying gold on the dips. And for all these reasons, you and I have talked about these before. You've got the BRIC nation looking to create gold-backed security, to reduce reliance on the U.S. dollar. Globally, governments have these real fiscal problems. We talked a lot about those. So as we've got the huge debt problems in the U.S., Canada, and most of the developed countries. And these debts are inflationary, so that reduces the purchasing power of currencies. And so that's a key driver as well. So central banks, especially the ones that are not friends of the U.S. in the West, so we're talking China, Russia, Iran, they've all loaded up on gold. If we look at seasonality from October to December, that's typically a really good time for gold. So pullback here, again, another good opportunity to add to your gold positions. In the bigger picture, I know I've mentioned this a number of times in your show, I expect to see gold over $3,000 in the next year. We're getting close. This is a nice pullback, but I think we're going to get some traction again soon. So we'd be looking to add to our gold positions and get any significant pullback here. 2510 would be the next key support. And if that one fails, the 200-day moving average is at 2410, and that would be our next target to jump back in.
What's going on with Bitcoin?
Well, Bitcoin is, it's surged since the election. So it's up, 30%, I think, since Trump won the election. It peaked this week at 93,400, but it's found kind of a range bottom around 87,000. Currently today, last I looked, it was about 91,000. So why the big push for Bitcoin? We've heard Trump campaign that he would make the U.S., the crypto capital of the planet, I think he called it. He also said he was going to create a strategic Bitcoin reserve, and he said he'd fire the current SEC chair and replace him with a much more crypto-friendly appointee. Well, I mean, right there, the investors love that. So we just saw, like I say, crypto went up about 30% since the election. So what we're seeing now, we're kind of seeing like Bitcoin, along with the U.S. dollar, has kind of been acting as like safe haven plays. So, just on Wednesday, we saw, $500 million flow into Bitcoin exchange-traded funds. So, Bitcoin's very volatile. We're seeing moves of $2,000-$3,000 a day. I think it was up about 3,000 today at one point, after being down about 1,500 earlier in the day. So it's getting overheated. Again, it's very volatile, but like gold, to me, buying the dips makes a lot of sense.
Dr. Copper has really fallen since the U.S. election. Why?
Yeah, that one's a little perplexing. It's very interesting that since Trump got elected, we're almost seeing a deflationary scare in the commodity sector. As you just said, copper is often referred to Dr. Copper because it's considered this reliable indicator of global economic health. Well, this reputation, it's based on, the widespread use, it's in all these different industries linked to economic growth, construction, manufacturing, electronics, infrastructure, the whole green movement. So what's really happening here is that as soon as Trump got elected, copper's fallen like an anvil. So Dr. Copper is suggesting that we're heading into a deflationary cycle. And if that's true, that makes it pretty hard to get too excited about the economy. So this is something, it certainly caught our attention. We're watching copper and these other commodities like a hawk. The deflationary cycle idea is one thing, but we also have to remember that copper and most of these other commodities, they're getting absolutely whacked because of the strength in the U.S. dollar. So that's something that, we'll watch for, because if we do get a correction in the U.S. dollar, then we're going to see if these commodities can come back to life a bit here.
What do you see ahead for crude oil?
Well, ever since oil hit about 72.5, just before the election, we warned it was likely to drop below 70 and test the previous support around 66. So since then, it did drop below 70, and here we're looking today, it's about 67.10. So pretty much bang on to what we were looking for. As I just mentioned, a strong U.S. dollar has hit most commodities pretty hard. But keys to why oil's declined, well, you've got supply surplus, we've got near-term demand weakness, especially in China, and of course we've got Trump with his drill baby drill mantra. That would increase supply. And like we just said, you've got the strong U.S. dollar. So what would cause oil to rise? Well, basically, any escalation in the Middle East or in Russia and Ukraine. But, for the long term, we're looking for oil to do quite well. You've got growing demand, certainly in those emerging countries. You and I were talking just before we chatted here. Oil's got such a big component of so many things that we use every day. Clothing, phones, computers, shoes, medical supplies, tires for cars, and even those EV cars have to have tires. Roads all these cars drive on. And then, you've got all these people in the emerging markets that they want these things too, and they need them. So I don't see the demand dropping dramatically anytime soon. And then, of course, if you look on the supply side, we've got lack of investment, capital expenditures are at multi-year lows, multi-decade lows. Rig counts are declining. Up to recently, up to the U.S., this U.S. election, up to then, globally, we've seen governments basically tell us they don't want fossil fuels. And, they've been increasing taxes, increasing regulations, not allowing new permitting. And, the combination of all of that is basically creating a supply and demand problem where, an increase in demand and a concerted effort to squeeze supply, that's going to pump up the price of oil. So it will be interesting to see when Trump gets in and how much the U.S. increases production, et cetera. But I think longer term, I still see a strong demand for oil going, multi-years.
Going back to the stock markets again, what are you looking at as we near the year end? Will this rally keep on ripping higher?
Can it keep ripping higher? Yeah, of course. It certainly can. But right now, we are seeing a pullback, and we're watching it closely. We've been calling for this a little over a week ago. We're seeing the S&P 500 rolling over a bit on Thursday. It's down about another 80 points here as we're getting close to the close on Friday. So it closed, it's around 58.75. The 20-day moving average is 58.60, so it's very close to that initial support level. And if it stopped there, that would be a small 3%, drop from the high of over 6,000 a week or so ago. The 50-day moving average is 57.60, so that would be about another $100 down, and that would take it to about a 4.25% drop. 100-day moving average is 56.30, so that would be about another $250 down from here. So that would be about 6.5% from the all-time high. So again, nothing alarming there at all. Now, if we drop down to the 200-day moving average around 5,400, that would be another 450 points lower. And that would take it to about a 10% decline, which would be normal. That's a very normal type correction in a bull market. Now, if we did get a break below that 200-day moving average, that would say that we should start to sit up and take notice here. Right now in our trend letter portfolio, we just went to neutral last week. So we added a short position just to hedge our long position. So again, we're neutral there. So we're just kind of watching this pull back closely. We want to get a good mix, look at the mix of it. So, the other thing that we're seeing here, as I mentioned earlier, we're getting these kind of mixed messages where the bond market is telling us it's worried about inflation. We've got those yields rising. We've got the central bank, the Fed saying, they may hold off rate cuts because obviously they're a little bit concerned about inflation. Like I said, Powell threw cold water on hopes for a December cut, saying that they have some concerns about inflation. And then, as I mentioned just earlier, Dr. Copper in the commodities, what's happening there suggests that market's actually looking and concerned about deflation. So we're getting this really weird mix where we got, one market's worried about inflation and then the other market's worried about deflation. So, and either one of these doesn't really jive with a good roaring stock market. So that tells us, that we need to, be careful here. So right now, I think that we're at the start of a correction in the stock market. And just for your listeners, if you are leveraged along, meaning that you borrowed money to invest, you should really take a look at, either taking some profits off the table or at least looking to add some hedge positions. Our technical trader service has a number of very easy to use exchange traded funds that protect your portfolio if this pullback becomes something way, more drastic. It's been a great run, but, one of the things that we keep hearing is, that there's no way stocks can be down here with Trump coming in. Well, actually, there is a way. When everybody gets on one side of the boat, that boat can tip over. When the markets always correct themselves, when it gets overbought or oversold, you always see it come back to them. The long side of that trade was getting very overcrowded. It doesn't mean it's going to tip over right here, but it could. There's something else that's really, that's kind of popping into my mind here every once in a while. What if there was another attempt on Trump's life? And what if this one was successful? I think that would tip the boat over for sure. So, and as investors, we need to park our political bias at the door. Many people can't stand Donald Trump the person, and I get that. But if he takes office, so if there's no black swan event there, and he implements the policies that he's run on, that is going to be good for business. It's going to be good for the economy, and that's going to be good for the stock market longer term. So right now, the Trump euphoria from Wall Street, it got overheated. It's taken a time out. How far it falls back, we're going to see. We want to watch those moving averages I just talked about. do understand that from November to the end of the year is typically a strong seasonal period for the markets. And then, as we get to December, the Santa Claus rally typically kicks in. So if we do not get a black swan event, then this current pullback should be manageable. And we will continue to monitor it for our subscribers and keep them up to date on how we're playing it. One of the things that I hear a lot about from people is a lot of people, they get anxious if they miss a big run like we've just seen in the markets, or the big Bitcoin run. And, many people just jump in at the last minute. A lot of people jumped in the stock market just last week. And now the market's pulling back. And as investors, you need to understand that if you miss a good trade, there's always another train coming. There's this great old trading adage, it's better to be out of a market wishing you were in than in a market wishing you were out.
Martin, thank you so much for being on This Week in Money.
My pleasure, Jim. Thanks for having me.
My guest has been Martin Straith, founder of Trend News, online at thetrendletter.com. He was speaking to us from Coquitlam, BC. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, and Martin Straith. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.